Listen carefully, because the silver market is no longer sending the kind of signal you can dismiss as ordinary volatility. I am not talking about a minor correction, a temporary rally, or another burst of enthusiasm that disappears when traders lose interest. I am talking about a structural pressure that has been accumulating inside the monetary system for years, and silver now sits directly where several of those pressures are beginning to meet. You need to understand what is happening before the price itself forces everyone to pay attention. Most people will wait for confirmation from television, major banks, or the financial headlines. By then, the important repositioning may already be underway. Markets do not announce regime changes politely. They move quietly while the majority remains comfortable, then violently when old assumptions can no longer survive. Ray Dalio's debt cycle framework matters here because it begins with a simple reality. Debt creates claims on future money. When those claims grow faster than the productive economy supporting them, the system becomes increasingly dependent on low interest rates, expanding liquidity, and continued confidence. For decades, that dependency was hidden by falling borrowing costs. Governments borrowed more. Corporations refinanced cheaply. Asset prices rose. Investors mistook financial expansion for permanent stability, but the arithmetic has changed. Debt burdens are larger. Interest expenses are heavier. Fiscal deficits are persistent. Political leaders still promise benefits, defense, infrastructure, and economic support, yet the revenue required to meet those obligations is not keeping pace. Central banks are trapped between protecting the currency and protecting the debt structure. Tighten too aggressively, and they threaten credit markets, banks, property values, and government financing. Ease too quickly, and they risk reigniting inflation while weakening confidence in purchasing power. This never ends quietly. I want you to recognize the consequence of that trap. Policymakers may speak about discipline, but incentives usually push them toward liquidity. They may tolerate higher inflation, suppress real interest rates, alter regulations, or expand balance sheets when financial stress becomes politically unacceptable. The exact mechanism can change. The outcome is familiar. The real value of money becomes the adjustment valve for obligations that cannot easily be reduced in nominal terms. That is why the silver story is not really about a metal climbing from one price to another. It is about what happens when confidence in financial claims begins to compete with demand for scarce tangible assets. The number $7 sounds impossible only when you assume the unit measuring silver will retain the same purchasing power, credibility, and scarcity relationship it has today. Change the monetary denominator, change global capital flows, and change the balance between physical demand and available supply, and previously absurd prices enter the range of discussion. Do not misunderstand me. I am not saying silver reaches $7,000 next week, or that any precise target is guaranteed. This is not speculation disguised as certainty. I am telling you that the path toward extreme repricing begins long before the final number appears. It begins when debt servicing consumes more fiscal capacity. It begins when inflation becomes politically easier than austerity. It begins when institutions question whether nominal returns are preserving real wealth. It begins when physical demand tightens a market that paper pricing has trained investors to underestimate. Those beginnings may already be visible. Look at silver's unique position. Gold is primarily understood as a monetary asset. Copper is primarily understood as an industrial material. Silver carries both identities. It is tied to electrification, advanced electronics, solar infrastructure, data systems, defense applications, and high-performance manufacturing. At the same time, it remains embedded in the historical psychology of money. That combination is powerful because industrial buyers cannot simply abandon essential inputs when investment demand begins rising. Supply is not a switch that miners can turn on. New projects require exploration, permits, financing, construction, skilled labor, energy, and years of development. Much silver is produced as a byproduct of mining for other metals, meaning higher silver prices do not automatically create an immediate production response. When demand expands faster than supply, inventories absorb the difference. When inventories tighten, price becomes the mechanism that decides who receives the remaining metal. Most investors are completely blind to what is forming because they watch the quoted price and assume the quoted price describes the entire market. It does not. Price can remain contained while physical strain develops underneath. Futures contracts, derivatives, and leveraged positioning can create an appearance of abundance, but paper exposure is not identical to deliverable metal. During calm periods, the distinction seems irrelevant. During a confidence shift, it becomes everything. History has proven this again and again. A system appears liquid until too many participants request the same scarce asset at the same time. A currency appears stable until holders begin reducing exposure. A debt market appears orderly until refinancing becomes dependent on intervention. The break is rarely caused by one event. The event merely reveals an imbalance that was already there. Silver holders, this is the moment to stop asking only whether the price rises tomorrow. Ask a more serious question. What happens when monetary demand, industrial necessity, and constrained supply converge inside a world carrying unprecedented financial claims? That is the question behind the $7,000 scenario. And once you understand it, you realize the real danger is not volatility. The real danger is recognizing the regime shift after capital has already moved. Now consider what capital does when old portfolio assumptions begin to fail. For decades, investors believed financial assets would rescue one another. Stocks provided growth, bonds provided stability, cash provided liquidity. When weakness appeared, central banks lowered rates, bond prices rose, and cheaper money supported equities. That relationship shaped portfolio construction, but foundations built under one monetary regime do not necessarily survive the next. When inflation remains unstable and government borrowing stays elevated, bonds can stop behaving like protection. Their payments may remain fixed while real value erodes. Cash may feel safe, yet safety measured in currency units is not the same as safety measured in purchasing power. Stocks may rise, but part of that rise can reflect monetary dilution rather than genuine productive improvement. Investors can look wealthier on paper while becoming poorer in the real economy. You need to understand this because the coming rotation will not begin with everyone selling at once. It begins at the margin. A pension fund adjusts an allocation. A sovereign institution adds tangible reserves. A family office reduces duration and buys scarce assets. A manufacturer secures critical materials earlier than usual. None looks dramatic alone. Together, they can redirect capital into markets too small to absorb it smoothly. Silver is one of those markets. The pools of money connected to bonds, equities, currencies, and derivatives are vast compared with the silver available for purchase. Only a small percentage must seek physical exposure before the imbalance becomes visible. This is why linear thinking is dangerous. People take today's price, add a normal annual return, and conclude that an extreme target cannot happen. They assume the future will be a slightly modified version of the present. Debt cycle transitions do not move in straight lines. Confidence changes slowly, then suddenly. Liquidity appears abundant, then becomes selective. Capital ignores scarcity, then competes for it. Price remains contained by habit until habit breaks. Once that happens, valuation can move far beyond levels that seemed reasonable under the previous regime. I am not telling you to worship a number. The $7 zeros figure is not the thesis. It reveals the scale of monetary distortion that could emerge. Ask what a price of that magnitude would mean. It may not mean silver became more useful overnight. It could mean the currency measuring it lost purchasing power. It could mean investors assigned a premium to physical scarcity. It could mean industrial consumers were competing with monetary buyers. It could mean confidence in paper claims weakened enough to force new price discovery. That process can become disorderly because physical markets cannot be expanded by decree. A central bank can create reserves, a treasury can issue debt, a financial institution can create more contracts. No committee can print refined silver into existence. No policy announcement can compress years of mine development into a quarter. When physical reality collides with financial demand, price must perform the adjustment. This is where the majority will make another mistake. They will interpret each sharp rise as proof that silver is overvalued. They will compare it with an old range from different monetary conditions. They will sell because the price looks high relative to the past without asking whether the measuring system changed. Experienced capital asks a different question. High relative to what? Relative to money supply? Sovereign debt? Government interest expense, new production costs, gold, paper exposure connected to a limited physical market. These comparisons matter more than a chart anchored to yesterday's assumptions. Listen carefully. Wealth protection is not about reacting to panic. It is about recognizing asymmetry before panic appears. If the thesis is wrong, a measured allocation to a scarce asset may still provide diversification. If it is right, Having no protection could be severe. That does not justify reckless concentration. It justifies preparation. The objective is not to gamble on collapse. It is to avoid complete dependence on a monetary structure facing increasingly difficult choices. Most people will not prepare because preparation feels unnecessary. While the system functions, salaries arrive, markets open, banks process payments, debt auctions clear, the currency remains accepted. They confuse continued operation with lasting health. But a machine can keep running while internal pressure rises. The warning is not that everything stops tomorrow. The warning is that maintaining the machine becomes more expensive, and eventually that cost is transferred to holders of money and financial claims. Inflation is one method of transfer, financial repression is another. Negative real rates, controlled yields, regulatory incentives, and currency depreciation can reduce debt burdens without an explicit default. The public may never receive an announcement that wealth is being redistributed. They experience it through higher living costs, weaker savings, unaffordable assets, and portfolios that fail to preserve purchasing power. Silver holders must recognize why this environment matters now. The early stage of repricing rarely feels decisive. It feels confusing. Prices advance, retreat, and advance again. Commentators declare the move finished. Weak holders lose conviction. Meanwhile, debt compounds, industrial investment continues, supply responds slowly, and monetary credibility becomes harder to defend. The path toward $7,000, if it is beginning, will not be smooth. It will be a sequence of pressure, denial, correction, and renewed acceleration. Those who understand that rhythm will focus less on daily noise and more on whether the underlying conditions are strengthening. When capital finally recognizes scarcity cannot be manufactured, repricing will not wait for the unprepared majority. Now I want you to think about the mechanism that could turn gradual pressure into a historic move. Repricing does not begin because the public suddenly agrees on a target. It begins when marginal demand meets limited supply, confidence weakens as inventories tighten, and institutions discover that the market they ignored is too small for the capital they now want to deploy. This is where silver becomes dangerous to underestimate. Investors buy funds, contracts, options, and synthetic exposure. They believe they own silver's economic performance and under calm conditions that may appear sufficient. But during a monetary transition, the distinction between exposure and possession becomes more important. Participants begin asking who holds the metal, whether it can be delivered, and how many claims depend on the same supply. Confidence can survive leverage for a long time. It cannot survive unlimited demands for settlement. I am not claiming every contract fails or the market stops functioning. Even a modest shift toward physical preference can alter the balance. When investors no longer accept financial substitutes as equal to scarce material, the price required to attract supply can rise quickly. Holders become less willing to sell. Industrial users secure inventory earlier. New buyers compete for a shrinking float. The market enters a different phase. That phase is driven by necessity. Manufacturers need continuity. Investors need protection. Governments need strategic resilience. Institutions need assets that are not another party's promise. Each group arrives, but their demand converges on the same ounces. This is how a market can move from overlooked to essential without the majority understanding why. You will hear people say silver cannot reach extreme levels because industry would substitute another material. In some applications, substitution is possible. In others, performance, efficiency, or redesign costs create limits. More importantly, substitution is not immediate. Factories, supply agreements, product specifications, and infrastructure systems cannot be transformed overnight. When shortages appear, businesses often pay more before they redesign. Price rises first, adaptation comes later. You will also hear that high prices will bring scrap into the market. That is true to a point. Recycling responds when incentives strengthen, but recycled supply must be collected, processed, refined, and returned to usable form. It can relieve pressure. It cannot erase every structural imbalance. And when holders believe the currency price will keep losing meaning, they may resist selling even at extraordinary levels. This is the psychological shift you must watch. At first, people sell silver because the price increased. Later, they hold silver because the currency decreased. Those are different behaviors. The first treats silver as a trade. The second treats it as monetary insurance. When that transition spreads, Models based on normal profit-taking can fail. Supply analysts expected to return remains unavailable because owners are no longer measuring success only in nominal currency. History has shown that monetary assets are valued not merely by utility but by trust. A bank deposit is valuable because you trust the institution and currency. A bond is valuable because you trust the issuer and future purchasing power. A derivative is valuable because you trust the counterparty and settlement structure. Silver requires a different kind of trust. It does not promise payment, it exists. That simplicity becomes more attractive when complex promises become harder to evaluate. This is why the path towards $7 zero cannot be understood through mining statistics alone. The target implies a transformation in the value assigned to certainty, scarcity, and monetary independence. It implies investors may pay far more for assets outside the expanding chain of liabilities. It implies confidence in traditional stores of value has weakened enough to redirect capital on a scale the silver market was never designed to absorb smoothly. Do not confuse this with an argument for abandoning discipline. A serious investor does not place every resource behind one forecast. Concentration creates vulnerability, even when the thesis is strong. Understanding silver is not about replacing one form of blindness with another. It is about recognizing that portfolios built entirely on promises may be exposed when the promise-making system reaches its limits. Ask yourself what protects you if inflation remains above returns on safe savings. Ask what protects you if deficits require persistent monetary accommodation. Ask what protects you if geopolitical fragmentation disrupts trade and material supply. Ask what protects you if central banks must choose between financial stability and currency credibility. Those questions are not predictions. They are risk management. The prepared minority does not need perfect timing. It needs a framework. It needs patience when volatility shakes conviction. It needs liquidity to avoid becoming a forced seller. It needs diversification so one incorrect assumption does not destroy the plan. And it needs the strength to separate temporary price weakness from deterioration in the long-term thesis. Most people will do the opposite. They will become interested after the largest move. They will buy because headlines create fear of missing out. They will use leverage because they believe acceleration will continue forever. Then ordinary volatility will remove them before the structural move is complete. Listen carefully. The greatest threat is not that silver moves too slowly. The greatest threat is that you remain unprepared until it moves too quickly. Once monetary distrust, industrial competition, and physical scarcity reinforce one another, the market may stop offering comfortable entry points. The public will finally recognize the signal. But recognition is not preparation, and late awareness can become expensive. So what should you do with this information? First, stop treating preparation as a prediction contest. You do not need to know the exact date, the exact catalyst, or the exact price path. You need to understand exposure. You need to know how much of your wealth depends on stable currency, liquid credit, rising asset valuations, and policymakers making perfect decisions under impossible pressure. Second, avoid leverage. A correct long-term thesis can still destroy an over-leveraged investor during a violent correction. Silver can rise dramatically and still punish anyone who cannot survive volatility. Strength comes from patience, liquidity, and the ability to hold through uncertainty without becoming a forced seller. Third, watch the system, not only the chart. Watch government interest costs, watch central bank balance sheets, watch real yields, deficits, physical premiums, inventory movements, industrial commitments, and the behavior of large capital. These signals will tell you whether the foundation beneath the repricing thesis is strengthening or weakening. The real question is not whether silver reaches one precise number. The real question is what happens to scarce assets when debt cannot be resolved honestly. Inflation becomes the least painful political option, and confidence begins moving away from promises toward possession. Silver holders, do not confuse calm with safety. Do not confuse a delayed move with a failed thesis, and do not assume the crowd will warn you before the regime changes. Crowds recognize structural breaks only after prices make denial impossible. I believe the path may already be forming, not as a straight line, not as an overnight event, but as a monetary transition gathering force beneath the surface. Prepare intelligently, remain disciplined, protect purchasing power, because when recognition becomes universal, opportunity becomes scarcity,